Good day, ladies and gentlemen, and welcome to the High Yield or Leverage Loans, What Should You Own in 2014 conference call. Today's conference is being recorded. At this time, I would like to turn the conference over to Mr. Faizan Danani, Head of Sales Horizons ETFs. Please go ahead, Mr. Danani.
Okay, thank you, operator, and welcome to our listeners. We look forward to your questions near the end of this call. We've been in a market over the last few years in which the appetite for yield has trumped all else. Despite strong equity returns, we continue to see very strong activity in fixed income purchases, particularly in the corporate bond space, leveraged loans or floating rate bonds, and some high yield. But 2013 was a paradox that we haven't seen much of before. Fixed income as a category actually lost money on a total return basis as benchmarked by the DEX Universe Bond Index. That begs a few questions that advisors have to be prepared to answer. What's in store for the fixed income market for 2014? What are your best fixed income opportunities? And if you own or have been looking to own leveraged loans or floating rate bonds, what risks should you be aware of? Aegon Capital Management, who manage over $300 billion globally, recently wrapped up their three-day fixed income conference in New York where the CIO, Mark Goldfried, surmised that fixed income will be a tough asset class in 2014 and that the best performing fixed income sector will be high yield bonds. If ever there was an introduction worthy of today's call, that might be it. I'd now like to turn the call over to Derek Brown, Senior Portfolio Manager of Fixed Income at Fiera Capital. Fiera is one of Canada's largest independent fixed income managers and a sub-advisor of all 7 Horizons fixed income ETFs. Derek will take you through the current state of the fixed income market as they see it and why high yield bonds make an especially attractive sector. Thanks, Derek.
Thanks, Faizan. So I'm just briefly going to go through the slide presentation, and really we're just going to start with kind of a state of affairs and what happened last year. So on the first slide you can see here just the different fixed income asset class returns for 2013. So U.S. corporates down about 1.5%, same as Canadian federal bonds. DEX Universe down just a little over 1%. On the positive side we have Canadian corporate bonds that returned almost 1%, but you see the big standout again was high yield at 7.4% in 2013. Now, just because we had good returns in 2013, and it doesn't necessarily mean they last over the long term, is what I hear from a lot of people. But if you actually look at the historical risk-adjusted returns from 1999 to 2013, high yield actually does stand out pretty remarkably on a Sharpe ratio. So if you look at the DEX Universe bond, you're looking at a Sharpe ratio of 81 basis points. If you're actually looking at the DEX High Yield Bond Index, it's at about 73 basis points. So that's a pretty significant Sharpe ratio. And again, what that has to do with is that long term, there's been really significant annualized returns in high yield, and we'll go over that a little bit later. But as you can see, as a risk-adjusted return, it is pretty significant. Now, obviously, double Bs performed the best, and triple Cs performed the worst on a risk-adjusted basis, just due to the standard deviation. One important fact I think we should point out as well is that if you look at the annualized returns between 1999 and 2013 between high yield bonds at 7.5%, leveraged loans only performed just over 5%, and they have a volatility that's a standard deviation of 5 as well. So their Sharpe ratio is actually significantly worse than a high yield bond index, and I think that's something important to point out. Now, you've probably heard a lot about high yield bonds, so I'm not going to spend too much time on the following slide, but this is really just to throw in what are they. Obviously, the lower than investment grade, double B or B or triple C. Coupons generically have been between 6 and 10%, 5 to 8 year terms. That's changed a little bit recently with the low interest rate environment that we're in, so you're probably seeing yields somewhere, or coupons somewhere around the lines of 5 to 8, 5 to 9%. In terms have actually gone a little bit longer as well, somewhere along the lines between 6 to even 10 years. And really what this provides a potential for is really, just switching out of traditional fixed income, especially in the type of market environment that we're in right now, gives you significant capital appreciation potential, which is something that does not exist in leveraged loans, and we'll go into that a little bit later as well. And you're also getting significantly lower risk than the equity market, about half the risk if you look at this slide we showed before with the Sharpe ratios. In addition to that, what we've seen a lot in the institutional world is more and more clients having to make the choice between capital preservation or yield enhancement. And some have made the decision to go with capital preservation, which is that they made a lot of money with rates falling over the last 3 to 4 years, and they decided to lower their duration. But there's a significant amount that have actually decided to look at yield enhancement, and more we're getting institutional clients into our institutional high yield bond pooled fund looking to put in 5 to 10% of their total fixed income allocation into high yield. The reason for this is that they can significantly lower their duration versus a DEX universe portfolio and actually pick up a significant amount of yield, even with only a 10% in there. As for high yield bonds, it's really important to point out as well that they actually have historically a negative correlation with interest rates. Again, something we'll talk about on the next slide. And that's something really important for the environment that we're in right now. And default rates are expected to remain below 3% in 2015 through 2015. So you'll probably see last year I think we finished somewhere around 1.7, 1.8%. This year will probably tick up a little into the low 2s and maybe closer towards 3% when we get to 2015. So total returns again in 2013, let's first break down by different asset, by rating, so quality bucket. So you can see high yield corporate bonds did 7.4%. IG bonds and AAA bonds did quite poorly. If you look at the asset class total returns on the right hand side, you can see obviously that the S&P performed extremely well. I think we're all aware of that. In 2012 it did as well with 16%. If you look at high yield bonds underneath, in 2012 high yield bonds actually kept pace with the S&P, which is pretty significant. Last year obviously we took a little bit of a step back from the 15% return, but still returned well over 7%. When I think looking down you can see where loans are around 5.2. That's pretty much historic averages is what we achieved last year. 7.5 in high yield is about a historic average, and 5.2 in loans is about the historic average. So you can see, even with interest rates moving higher by 130 basis points last year, high yield bonds were still able to outperform loans, even though they have their their floating interest rate component, which is not as clear as you perhaps think it is, and again, something we'll address a little bit later. Now, historical returns, this just shows over all asset classes over the past 15 years. And high yield bonds are actually the second best performing asset class, ranking only second to emerging market equities. We can look at a couple of the down years, obviously 2000 with the tech bust, down 5%. But high yield in 2001 was up about 4%. 2003 is really when it started taking off again, up 28%. In 2008, in the credit crisis, high yield bonds were down about 26%. Important thing to look at is that right below that, if you actually look at loans in 2008, loans were down 29% in 2008. 2009, obviously, corporate bond spreads rallied pretty dramatically, or tightened pretty dramatically, led to high yield having a return of 57% in 2009, again surpassing loans, which only returned about 52%. So just the difference in those 2 years alone, outperforming loans by 3% in 2008 and then outperforming them by 5% in 2009, compounded, that's looking about 9% just in those 2 years. So it's pretty dramatic over the long term that high yield bonds have actually outperformed the vast majority of asset classes. An important slide here, and it's maybe not fully clear, but we'll go over it a little bit slowly, but this is historical performance of high yield bonds compared to other fixed income asset classes. So you can see U.S. government bonds in the light blue, IG bonds in gray, and then high yield bonds in the dark blue. On the left-hand side, we have the total returns over the entire period, so from 1994 to 2013. So you can see high yield bonds returned 8%, better than the rest of the asset classes in fixed income. The important one is really the one in the middle, returns in a rising interest rate environment. So you can see here that federal government bonds or treasuries obviously lose about 6%, which makes sense because of the duration problem that they have. IG bonds, because they're priced off the back of treasuries or Canadian bonds in Canada, they're going to lose as well as the yields rise. High yield bonds, however, actually perform extremely well when interest rates are rising, up over 9%. Now, obviously, when you go to the right-hand side, you see when rates are falling, so you're probably looking at a recessionary type of environment. So, 2008 obviously is a good example. Obviously, your treasuries are going to outperform high yield investment grade bonds perform really well because of that large duration component, and of course high yield bonds suffer a little bit because they have a large credit spread. So again, the middle one is really the one that's really important to focus on, is that when interest rates are rising, you have a very positive return in high yield bonds. We have a slide as well that's not included in this presentation but can be forwarded to anybody who wants to take a look at it. High yield bonds, as you can see on the right hand side, have a negative correlation to treasuries. The important thing to know is that even though it's 0.12 negative, it's actually during the first 6 months of an interest rate rise, as we saw last year in May, June, July, the correlation is actually positive. It's about positive 0.7, and it's only in the following 6 months, or after that first 6 months of interest rates moving higher, that the correlation goes drastically negative, and that's really just because your coupon's taking over. They become less sensitive to interest rates. The duration, is not as big of a problem. Generally, when you first start with an interest rate move higher, people are worried. Their carry trades need to be unwound. We saw what happened to emerging markets in May and June. High yield suffered as well. So generally, people like to unwind their levered carry trades when there's essentially the first sign of tightening from the Fed, and that's what we saw in May, June. So that's when you generally get a pretty positive correlation. After that, which is actually exactly the moment we're in, 6 months after May and June, so January, February, that's when your coupon and your yield really start taking over when it comes to high yield bonds, and your correlation is actually more negative than you would think than the 0.12. Historical spreads, I won't spend any real time on this, just to point out that spreads did quite well even during the sell-off of May, June of last year, and we're nowhere near quite our historical tights. They're on the left-hand side, the spreads, with the treasury rates on the right-hand side, and we're right around about 400, 420 right now in spreads. The historical tights were about 280, so again we've got about 200. We have a significant amount of ways to go, but 150 basis points to go before we get to the historic tights. I don't see us getting there anytime soon. I would expect we'd see a little bit of spread tightening this year, mainly driven by rising interest rates, not necessarily improving credit. We expect 2014 to be pretty much a carry year for fixed income or high yield bonds. So you're going to be looking at probably somewhere along the lines of 5 to 6%, give or take. You're going to lose a little bit on when interest rates go higher, but you're going to make it back when your spreads tighten. So all in all, we think that should net off, and you should pretty much just walk away with your carry. So again, somewhere around 5.5% for 2014 in high yield. Now, across the curve, you have pretty attractive quality. You can see there's a pretty large step up when you go from triple B to double B. You're getting up over 100 basis points. And then from double B to B, you're picking up another 100 basis points. And obviously the biggest step up is when you go from B down to triple C. Now the triple C bucket, just so everyone's aware, captures everything. So triple Cs, double Cs, Cs, Ds, and essentially defaulted debt. So it catches pretty much everything. It may not be defaulted, but it's distressed debt. So some of these would have 50% yield on them or something like that. So that's why it skews the number a little bit. But you got to be careful, because as you're reaching for that yield, it also leads to a higher potential or probability of default. And that's something that's really important in high yield that we want to point out. And it's here on this following slide. The average default rate is not really applicable in our opinion. That when you look at it, people talk about, average default rate in high yield is somewhere along the lines of 4%. That is true when you average things out from 1981 to 2012. However, if you look at it, and it's pretty obvious by looking at the chart, that it spikes. And it's really these recessionary type of environments, these contracting economic environments that you really want to avoid. So obviously 2007, it's a pretty significant spike. One thing to point out, though, is that there is places to hide in high yield. So one of the advantages of being an active manager is that we can move into triple Bs, which have an average default rate of 0.2. We can move into double Bs, which have an average default of 0.9. And even looking at the chart, double B issuers have never defaulted above 4%. So defaults have never exceeded 4% in double Bs. Historical average in B is 6.4%. Obviously, the triple Cs have the biggest ones, and the average default there is 24%. But if you look at 2008, it's pretty dramatic. You get up to about 50%. So we believe we are more of a top-down manager, which is something we'll get to again a little bit later. We believe that if we can see these and move around these economic cycles, take risk off, put risk on at the appropriate moments, we can add significant value over the long term. Because again, there's peaks and valleys in these default cycles, and avoiding the peaks is really what's important, and knowing what credit rating to be in. So again, as you can see, double Bs have performed extremely well historically, and that's a safe place in high yield. So just a quick talk on the market characteristics. Real basic, it's a pretty, our portfolio is pretty much in the U.S., it's about 90% U.S., and then 10% kind of more of a best ideas, which can be Canada, Europe, something along those lines. And just shows you that it's a fully diversified index as opposed to Canada. In Canada, there's probably about $12 billion in high yield, whereas the U.S., this is just the double B and B index, but if you include the triple Cs, the grand total would actually be about 1.3 trillion. So it's a huge market. It's essentially the Canadian market's only 1% of the U.S. market. So there's pretty significant market in there in the United States. So we can play a variety of different sectors: consumer cyclicals, energy, healthcare, so on and so forth. Now we're just going to talk a little briefly on leveraged loans, and perhaps some characteristics or let's call them dynamics that not everyone's 100% aware of. And these are just important. A little disclaimers. I do believe leveraged loans have their place in some portfolios. I think they're a good asset class. I just think people need to know what they're buying, and I don't believe everyone does. So just 4 things that people need to be aware of. The first one is the Libor Floor. The majority of leveraged loans out there have a Libor floor of about 1%. Some are 75 basis points, some are 125, but the majority are 1%. So what this means is, as Libor, which is essentially the Fed funds rate, goes below 1, these loans pay 1%. So that means right now Libor is 30 basis points. So to benefit from your floating interest rate, you would need Libor to rise above 1% before your incremental yield was given to you. So unlike, for instance, HFR, which uses a swap contract to do its floating rate portion, that benefits immediately as swap rates start going higher. This leveraged loans have a Libor floor. So the Fed has essentially told us they're not raising interest rates till probably late 2015 or early 2016. But let's just go with December 2015 as a target date. So if that happens between now and December 2015, no matter what happens to the 5-year bond or the 10-year bond or the 30-year bond, Libor is not going anywhere, meaning that leveraged loans would not benefit from rising interest rates. Now, they wouldn't get hit from rising interest rates because they're floating, but they're not benefiting from them in any way, shape, or form. It would only be once Libor gets above 1%, so 125. So you need essentially probably 3 to 4 hikes by the Fed. So you're probably looking at late 2016 before leveraged loans actually start benefiting from that Libor portion in the floating part. So for those who are using leveraged loans as a hedge or as a negative duration instrument, the way some people are using HFR, that's an improper way to look at it. It's a carry vehicle. It's something that's going to give you your 1% plus your credit spread, which is fine. Nothing wrong with that. But again, it's not there to hedge out the remainder of your fixed income portfolio. It's there as a carry trade, simply. It's a big bet on credit spreads, and that's all it is. The second thing that's really important is the 101 call. So the reason why historically high yield bonds have outperformed leveraged loans is pretty simple. There's a 101 call, that caps pretty much all the appreciation or most of the appreciation in leveraged loans. So when these companies write these loans to banks, they say, well, if our price of our loan gets to 101, we have the right to refinance it at the new market terms. This doesn't happen in high yield. Generally, the calls in high yield are length-based, so they'll issue a bond that for 8 years that's non-callable for 4 years. So you have 4 years where you get your coupon and things like that. And generally, the call price is significantly higher than 101. It's generally 103, 105, 107, so it's significantly higher. The problem with loans is that there's huge reinvestment risk because the minute you buy a B-rated loan and the company starts doing a little bit better and spreads start compressing, well, the price of the loan would go up to about 101. The company's then going to call back the loan and refinance at better terms, whether lower covenants, lower interest rate spread. So you're really capping the appreciation of loans, which again makes them a good carry instrument, but doesn't make them a good market appreciation or a credit story type of vehicle. If you believe that the economy is getting better and all these riskier companies are going to do significantly better as economic growth catches on and GDP rises above 3%, well, loans really won't give that to you because they're capped at 101. So you aren't going to benefit from improving credit stories. The third thing is CLOs. So CLOs are collateralized loan obligations. I think we've heard of these before. Back in 2007, 2008, there were CDOs, collateralized debt obligations, MBS, mortgage-backed securities. So all these different types of securitized vehicles. So what CLOs do essentially is they're a big portion of the leveraged loan market, probably around 40% of it. And what they do is they drive the pricing of it. So they'll buy a significant amount of leveraged loans. They'll slice them and dice them and repackage them based on statistics, recovery values, default rates, and essentially tranche them out into AAA portions, double B portions, triple B portions, and sell that to institutional investors. Now the reason why this is important for a leveraged loan buyer is that because the collateralized loan obligations are that big of a player, they're driving the pricing. The problem is they're looking at historical default rates and recovery values and statistics as opposed to actually looking at the credit quality and the credit story of the actual individual issuer. So they're not really focused on credit metrics per se. Well, metrics they look at, but they're not looking at the story, management style, what sector they're in. That's really not what they're looking at. It's just, does it fit into a certain box? Can Moody's approve it AAA? That's really what they're looking at, and they're driving the majority of the pricing. So therefore, credit spreads are tighter than they normally would be. There's also another issue with CLOs that we don't mention here, and the reason why is that it's relatively new. It only came out about 2 days ago. It looks like Dodd-Frank legislation is going to probably go after bank holdings of CLOs. If that happens, it's going to mean that CLOs will actually be smaller players in the market going forward because banks won't be able to buy them, which would be good for leveraged loan investors over the long term. But over the short term, there's going to be a significant amount of supply of loans, but less buyers. Generally, when you have more supply than you do demand, that causes prices to suffer. Again, I'm not negative on leveraged loans, but I think you just need to be aware of the market dynamics that are involved. So there could be a supply overhang causing loans to maybe suffer over the next 6 to 12 months, depending on how the Dodd-Frank legislation works out. Now, if it works out and banks are still allowed to buy it, then that won't be an issue. But if, they're no longer allowed to buy it, then it could become a little bit of an issue going forward. So something to keep an eye on if you do own leveraged loans. Then the last thing is liquidity, and I spend a lot of time on this slide, so I'm going to move on. But the ability to mitigate your losses in leveraged loans is significantly reduced. The market's very illiquid. Just to give a little quick story, that generally when we see these things called OWICs and BWICs that come through the market, and what they are is bid wanted in competition, offer wanted in competition. And it's a list, essentially, often from ETFs or large institutional players, PIMCO, Fidelity, saying, I want to sell $100 million worth of bond, $1 million in these 100 names. Generally, we'll get about 20 to 30 minutes to put in our prices if we want them and send it back in if I want to buy any of them. On the leverage loan side, I see some as well, but instead of getting 30 minutes, I generally get 1 to 2 days to put them in, because that's just how fast the market moves. It takes a lot longer for leverage loans to trade. It's a much more opaque market. In high yield bonds, you have what's called trace data in the United States, so they track trades every 15 minutes. The banks have to post them. This doesn't exist in loans. So again, the market's much more opaque, the pricing's more difficult, it's tougher to get in and get out. And I think as we showed before on that default slide, this market does have peaks and valleys in the default cycle, and to be able to get out of something when that default cycle approaches is really important. The ability to hedge, the ability to be an active manager who can use CDX contracts, who can short competitors' ETFs if I have to, can hold 10% cash if I need to, can move up in credit quality, is really important. So having this top-down view where we can actually hedge and use our liquidity to our advantage is really important. I just mentioned that we use CDX to hedge. We do at times. In the leveraged loan market, there really isn't a good instrument in the derivative market to hedge out. There is a loan CDX. It's called LCDX, but it's not the best to be honest, out there, it's not very liquid, and it's not a great hedging instrument. So I'm going to just quickly go to our strategy at Fiera and what we look at, and it's getting a little long, so I'll speed up a little bit. But essentially, our philosophy is to combine top-down and bottom-up approach. So as I mentioned before, it's really important for us to kind of understand where we are in the economic cycle, look at things from a macro top-down view. So real quickly, we think the economy in the United States is getting better. We'll probably approach, 2.8, 3% GDP this year, driven by a variety of factors. Housing market's going to contribute to GDP probably around 0.8%. The lack of fiscal drag, because we got the budget resolution last year, is going to increase it as well. So again, GDP somewhere around 2.8 to 3%, which points to us that you want to be long credit spreads in general. Now you got to pick your moments every now and then. I think at the beginning of the year things were a little too aggressive, but pull back. You've seen a little bit of a widening in credit spreads. We think this is probably a buying opportunity at this point. So we take that top-down view and really say, what do we think is happening in 2014, and what sectors are going to benefit the most? So we then look, what do we think is going to benefit in 2014? Right now we're looking at financials. We think if you look at a lot of the European structures out there, some of the hybrid securities, Tier 1 debt, and what's called COCOs or contingent capital, a lot of these structures are very interesting. With the new Basel III requirements, they're not going to count as capital on the bank balance sheet, which means most likely the banks will call these things. So we think that's a very interesting sector right now. We're overweight healthcare just due to the whole Obamacare situation that worked out very well for us in 2013. We think it continues into 2014. In 2013, we were dramatically underweight commodities and basic materials. We continue to hold that underweight. We're thinking we may take off that underweight and move it to neutral probably by mid-year of this year if we do see economic growth. So focusing on the top-down view and then into sectors is really important for us. And we do have a multi-strategy approach, which means we can use duration plus or minus 2 years. As I mentioned, the risk allocation, which is sector selection and credit risk selection. So our philosophy, as we look at it really quickly, duration management probably brings in about 10 to 15% of our alpha. As I mentioned, top-down view on macroeconomic outlook. So that's really our first and most important step. The second step is risk allocation. So once we have that top-down and macroeconomic view, we then say, well, where do we want to take our risk? Do we want to be in all in triple C's? Do we want to be in double B's, triple B's? What sectors do we want to be in? That's really important because by choosing the right sectors and which ones are going to benefit are really, really important. If you had the best performing coal producer last year in the United States, you still probably lost about 1 or 2%. So avoiding coal as a whole sector was really the right play. Avoiding the steel sector was really the right play. Even if you had the worst performing telecom, you still made about 3% last year. So again, it's really important to understand what sectors are going to benefit based on the economic cycle. And then our last step, about 30% of the alpha, comes from security selection. So once we decide which sectors we want to be in, then we take the normal bottom-up way of looking at things, breaking down balance sheets, understanding the story. Are these credible management teams? Are they executing on what they say they're going to do? Credit analysis, both in-house and external, really important for what we do. We have 3 really solid credit people that work with us. Worked at bank desks, in London, in Toronto, in New York. And we also have another one from credit rating agencies. So, we really break things down and look at the underlying fundamentals of a company. But again, that's our last step. Knowing where to position and when to position is the most important thing. Because as we showed in the default cycle and the boom and bust nature of the high yield market, knowing where you are in the economic cycle to us is much more important than picking the best company in a bad market. So again, that's the most important thing for us. Then we're just going to quickly go on the top 20 issuers. So this is just the high yield index, Merrill Lynch index. So the top 20 issuers, you can see what we do is, we're, I won't say quasi-index like, but we spend about 80% of our portfolio, versus give or take the top 200 or 300 names in the index. And we pick winners and losers from there, so we're credit pickers in that sense. And then the remaining 10 to 20% is best ideas, as I mentioned before. So a lot of these are really large corporations that people have actually heard of that may have a lot of debt, but they have significant equity market caps as well. So Sprint is a huge telecom in the United States. We're a little bit underweight Sprint right now just because we think there's some M&A potential with them right now, so we don't want to be fully overweight. HCA is the largest hospital operator in the United States. We like the hospital sector. We like the healthcare sector, so significantly overweight there. One to point out is Energy Futures Holdings. So this is the fourth largest issuer in the index. We don't like this company at all. We don't own it, never have, and most likely never will. It's a triple C company that we believe, in our opinion and our analysis, is most likely going through restructuring, probably going to go bankrupt in the next 6 to 12 months, and we don't want to be involved. So just because it's the fourth rated in the index doesn't mean we're going to own it. Another company that we liked a lot, International Lease Finance Corporation. They do essentially leasing for airplanes. It used to be the leasing arm of AIG before it got spun out. This is a company that has $11 billion in debt. Doesn't matter, we liked it a lot. We were significantly overweight, believing that it would go from essentially a mid double B to triple B, and that's actually the case. It's been upgraded. As you can see, triple B minus by S&P. Moody's hasn't quite got there yet, but we believe that's coming, just in a matter of time. A couple other companies just to point out, these are large corporations. Metro's PCS is actually T-Mobile. SLM Corp is Sallie Mae. Dish, I think everyone knows Dish, and they're competitor to DirecTV. CenturyLink, if anyone out there is a Seattle Seahawks fan, you'll know that they play at CenturyLink Field. Huge corporation. Caesars Entertainment, large corporation as well. So these are really, really big corporations out there. Obviously, for all you Canadian investors, you'll know Valiant Pharmaceuticals with $10 billion in debt. A lot of that has to do with the Bausch & Lomb acquisition. We never owned Valiant until they bought Bausch & Lomb. Generally, it's a very highly levered company, and they generally try to take leverage up to 5 times, bring it back down to 3, and then lever up again. Once they bought Bausch & Lomb, that brought them about 5.2 times levered. We bought the company. They're now working their way down to 4. If they get below around 3.5, we're going to sell them again. So that's just how we move in and out of different companies. And obviously, everybody, I think, knows GM. So again, we have a similar weighting to the index, but we'll overweight certain names that we like and pick and choose winners from there. And really, I think that's most of what I have to say at this point. I'm handing it back to Faison at this point, and if there's any questions later, feel free to ask.
Okay, thank you, Derek. We're going to open it up for questions in just a minute. I just want to go through a few details before we get there. High yield as a sector, as a fixed income sector, has generally been one that historically has been a little more difficult to access with the advent of mutual funds and ETFs. Certainly has become a lot more accessible to most investors. The advantage of HYI is that you're able to access the expertise in the active management of Fiera Capital for a much lower fee than other alternatives at 60 basis points, and it does pay its distribution monthly, and its distribution is roughly around 6.5% at current yields. I'll let you focus on the green line for just a moment here, but this really highlights the benefit of active management and the intelligent approach that Fiera brings to the high yield space, avoiding companies like Energy Future Holdings in their portfolio so they can ensure that they're navigating you through the riskier avenues of credit to deliver you the best risk-adjusted returns in the area. And here are those numbers just numerically for you here. And as you can see, it has been a top category performer, especially when you compare it against its index-based counterparts or index-based ETFs. Derek talked a little bit about leveraged loans. I just wanted to quickly mention HFR, which he made reference to a couple of times. We understand for most of your clients that going all into high yield in their fixed income allocation is not an option. We heard that in leveraged loans you can trade credit risk for lower duration. So if lowering duration is important to you, you can do so in a liquid investment grade bond ETF, and that is HFR. And the benefit to perhaps pairing that together with the high yield ETF HYI is that you can customize a yield and duration trade-off how you want to. So this grid just really shows you, for instance, by combining the two in different proportions, what type of duration and yield combination you can achieve. Just for interest's sake on this slide, if you think about where corporate bond, investment grade corporate bond indexes are right now, they have about a 5.67 year duration with a 3.5% yield. So if you want to get a comparable yield, according to this chart, you would allocate 70% to HFR, 30% to HYI, and you would get a comparable yield, but a duration that's almost 4 years less of a credit or an investment-grade corporate bond product out in the market today. So just allows yourself to get a little more flexibility when you're constructing your fixed income allocations, either on your own or for your clients. With that, operator, I'd like to open it up to any questions that we have from the phones.
Thank you. Ladies and gentlemen on the phone lines, if you would like to ask a question, please signal by pressing *1 on your telephone keypad. If you're using a speakerphone, please make sure that your mute function is turned off to allow your signal to reach our equipment. Again, please press *1 if you have a question. We'll pause for just a moment to allow everyone an opportunity to signal for questions. Please stand by. Ladies and gentlemen on the phone lines, as a reminder, if you have a question, please press *1 on your telephone keypad.
Maybe I'll kick things off, operator. Derek, can you comment a little bit on, I know you touched on it before, but on actual realized default rates that you're seeing in the U.S. versus Canada in the last year or 5 years?
Sure. Well, in the U.S., like I said, last year was probably somewhere around 1.7, 1.8%. Canada's had a little bit of a lower default rate. We've been lucky in that sense. We've only had one major, which was Yellow Pages, and then another smaller one, which was Skylink Aviation. So those are the two that have been gone bankrupt probably in the last 4 to 5 years in Canada, well, 4 years at least. For our account, we actually haven't seen any. We've had a zero default rate since managing the portfolio, well, since inception. So, again, one of the benefits of active management is when the ability to get out of a distressed credit, by remaining, relatively liquid as much as possible, and even if you can't get out, at least hedging so that the performance doesn't suffer.
Operator, any questions on the line?
There are no questions on the phone line. Please go ahead.
Okay. I'll just ask one follow-up question just in the portfolio itself. What do you typically see as your split between U.S. and Canadian high-yield issuers?
The split in our portfolio is about 90-10. We spend primarily in the U.S. With just more liquid and things like that. The Canadian market for us, you do see some issues. It's been really quiet recently, whereas the U.S. is extremely active. Canadian market hasn't seen a new issue, I think, since December. River Creek Casino came. It's an Edmonton casino that came in December. But since then, not much has actually happened in the Canadian market, so it's been quite slow. Again, the U.S. extremely active, large corporations. It's where we prefer to take our risk at this point. So again, we tend to avoid the Canadian market just because of the concentration in the material sector. A couple of large issuers, Bombardier, Videotron, are major Canadian high-yield players. So one or two major players can actually move the entire index. So for us, we prefer to avoid for the most part, Canadian issuers.
Okay, thanks, Eric. Operator, back to the line.
There's a question from Frank Shamendi of National Bank Financial. Please go ahead.
Yeah, hi. I was just wondering, when you talk about leveraged loans, do you use senior loans and leveraged loans interchangeably, or?
Yeah, so senior loans is just a fancy name for leverage loans. What it means is that it's a marketing thing to say senior loans. They're really part of leverage finance, which would be leverage loans and high yield bonds. And even high yield bonds is a marketing name, right? It used to be junk bonds. So yeah, so senior loans is exactly that. It's a nice name. Really, at the end of the day, what you're getting is you're getting a loan, a senior loan, or a loan from a high yield company. That's really all you're getting. If these were investment grade quality loans, the banks would keep them on their balance sheet and not be spinning them off to investors. So these are generally the loans that banks don't want to hold on to their balance sheet, just for maybe capital reasons. There's a lot of reasons. Not to say that they're bad companies and they're all going bankrupt. That's not what I'm saying. But the name senior is just, they're saying that in the order of default, that it's more senior to have a loan than it is to have a bond. But even that statistic on its own is not a fantastic statistic, because if you look at the actual recovery value on a loan, historically it's about 60%. On a high yield bond, it's generally around 50%. So yeah, you're getting a little bit better recovery value, but you're also getting significantly more yield in high yield bonds. So again, if you're worried about default in general, you might not want to be in the high yield or leverage loan sector, because if that's your view on the economy. So that's the way I look at it.
Okay, thank you.
Thank you, ladies and gentlemen. As a reminder, if you have a question, please press star 1 on your touch-tone phone. There are no further questions at this time. Please continue.
Okay, thank you. We'll wrap up the call then. Thank you, operator. Thank you, Derek, for your time in talking about high yield and leverage loans. For those listeners that are interested in HYI, HFR, or learning a little more about how to blend the two together, or any of our fixed income ETFs that's run by Fiera Capital, please visit us on our website. It's www.horizonsetfs.com. You'll find all of our contact information there, and you'll find all of the information, fact sheets, and product profiles for you to browse through. If you are an investment advisor, we encourage you to get in touch with one of your wholesaling teams, and we can better assist you. Thanks, everyone, for your time this afternoon, and have a nice day.
Ladies and gentlemen, this concludes the conference call for today. We thank you for your participation. You may now disconnect your lines and have a great day.